Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. Good to be here with you this morning.
Nice to be with you. So I had a live stream the other day, and a lot of people were asking about what the Fed meant by pain is coming, right? There's pain ahead, more pain ahead. I kind of talked about, hey, basically unemployment is going to go up. But as I kind of reflect on that statement, something I wanted to ask you and many of my other experts is simply said, is the Fed trying to make the average American poorer? What do you think?
Boy, this is a loaded and very complex question. So, I don't think the Fed wants to make Americans poorer. I think the Fed continues to make mistakes in implementing its mandate and continues to expand the mandate, which ends up with unforeseen consequences. They should have foreseen them. They don't, and they make the same mistakes every 20 or 30 years. But generally speaking, if you'll humor me for a
Sure.
second,
No, please.
the Fed really is supposed to maintain price stability, right? So they're
Correct.
supposed to maintain an inflation. They have set the norm and acceptable inflation rate at about 2%. And for the longest time, they were really supposed to stabilize money and make sure that inflation didn't get crazy over about 2%. At some point, the Fed decided to take a dual mandate, and that is to keep unemployment low, to keep workers working. And so by manipulating interest rates, which was the only tool in their tool belt really for decades, they attempt to lower interest rates to stimulate the economy by encouraging companies to borrow more money. The hope and the thought early on was if interest rates are low and companies are borrowing money, companies will then invest in future resources. They'll invest in new jobs and new technologies, which will get the economy really ramping up and booming. And it'll be prosperity for all because it will trickle down into higher wages for more people, followed by more spending because of higher wages. And then it's supposed to just stimulate the economy and make the US economy continue to purr and grow constantly at a rate above inflation so that you have positive gross GDP. Unfortunately, if the Fed doesn't get interest rates right, if they keep rates too low for too long and companies continue to borrow, but they don't really invest in new technologies and they don't really invest in new jobs. If interest rates are low for too long, companies make more money by borrowing more money, buying back their own stock, and financial engineering. And what's happened over the last several decades is companies have actually made more money in their financial engineering than they have in selling goods and services. So this always ends up having kind of this ricochet effect where eventually so much debt is in the system at such low rates that it's not sustainable anymore. And we end up with inflation. And that's where we are today. And there's a lot of other factors that make that happen. But after 2008, the Fed also started really playing with the money supply, how much money they put out into the country and how much money they pull out, what kind of things they prop up. And that impacts how institutions invest and what they do with their money. And ultimately, now when you have hot inflation and inflation's, now over 8 instead of 2, the Fed has no choice but to try to really slow down the economy. And when they do that, it means they're slowing you into a recession. They talk about soft landing. We're trying not to hit a recession versus a hard landing, which is a deep, hard, diffuse recession. And essentially, they have no choice because if they don't stop it, you're going to have rampant inflation, and that's bad for everybody. It's a tax on the American people, the poorest of the poor. And so they've created this monster by making money too easy, too much money supply, and rates too low for far too long, over a decade minus, a few months here and there. And that basically is going to require a recession, which leads to people spending less money, right? Because prices were high, they're spending less. In a recession, they start losing jobs. Their wages go down, they spend less money. Companies have to lay off. They can't produce as much because people aren't buying as much. And ultimately, it hurts both corporations, financial institutions, and the average worker. And essentially, that's what the Fed is forced to do to correct their own problem that they created And yes, that will cause a crushing of the American people, asset prices, stock market, retirement funds, etc. Do they want it? No. Did they cause it? Yes.
I think that is so well said, and you did dance the line very well. Because I think you're right. I think if you gave the Fed true serum, I yeah, I don't think they want the average American to be poorer. I mean, that's likely, that's first off not in any of their mandates, and they, that's not what they wake up hoping to do, right? But they now are looking at a situation again that they've created. They've kept rates too low for too long, arguably for decades, to your point, not just since the pandemic, right? This was, this has been going on. QE has been going on for 12 or 15 years
Yes.
or whatever it is. And now, the system is so backed up that we have inflation over 8%. More importantly, I think we have core over 6%,
Yes.
which is going to be very interesting with rent and wages and in the wage effect and all of that coming on. I think the Fed was very clear. Unemployment's going up. I think they will admit that that's going to happen.
Yes.
Right. We're
and
going
it's
to have
happening.
Yeah. And it's happening, right? Went from 3.5 to 3.7 in the latest report and going higher. People always ask me, well, how high? Higher, right?
Yes.
It's certainly, I think without question goes over 5. Does it go over 6? No idea, but certainly over 5, I think is, in the next 12 months is reasonable.
Sure.
The other thing they want to do, again, that I think the Fed focuses on is something that, average commentators call the negative wealth effect.
Yes.
Because again, that's demand, right? Whether you like it or not, when you feel richer, wealthier, you spend more, you take on more debt. When you are scared, and we are a consumer-based economy, there's this thing called a negative wealth effect. And again, to your point, I don't think the Fed wants you to be poor, but they want you to feel poorer.
Yes.
And I think there's a subtle difference. What do you think?
Yeah, I think that's really astute, of you to say, because really they want to stop spending. They're not trying necessarily to crush your wealth, crush your retirement accounts, et cetera. But the problem is most people don't invest, period, right?
Correct.
Over 70% of the population doesn't have any investments other than maybe a small 401k. So unfortunately, most people's wealth is tied up in a 401k. It's in the stock market, right? Well, when the entire portfolio that you own is based on companies and financial institutions who have made so much money because of a decade plus of cheap debt, these companies are in for a rude awakening. A lot of them have so much debt on their balance sheet because it's been wiser for them to financial engineer and use debt to make money, that now that that's stopping, a lot of them have variable interest rate debt. And that means that they have to continue to figure out how to pay down their debt, sell enough stuff to, continue to not be a zombie company, which are, a quarter of NASDAQ, I think, is a zombie company.
Wow.
Zombie companies that are basically in the negative, right? And so the stock market is reacting, horribly because they know, hey, the party is over. This era of cheap money and financial engineering is over. And we can't really provide enough jobs if people aren't spending. And so they have to start, laying people off. So one of the things that has happened, and I've studied the Fed, I bought a 3-volume series on the history of the Fed back to, the start. So I've studied the Fed quite a bit, is they keep making the same mistakes. And that is they're because they're focused on, really inflation and unemployment. They pay very little attention to asset prices, because when asset prices go up, they think, hey, this is a sign of a really strong economy, right? We want asset prices to go up. We want companies to get wealthier, people to get wealthier. It's a boom, right? It's not overheated. But what happens is at some point, they're because they're not focused on asset prices, they don't say, wait, things are way out of a line, right? When stock is trading at 300% more than what the fundamentals allow for, when real estate values are significantly higher than what the fundamentals allow for, you really enter the asset bubble territory. Everything is overvalued compared to the underlying fundamentals that support the valuation. And almost like clockwork, they don't do anything until an asset bubble starts to crack. And once that asset bubble starts to crack, There are many, very experienced investors that run hedge funds and, the wealthy of the wealthiest that say we are in an everything bubble. Everything is way overvalued based on the fundamentals, and it's because it's entirely propped up on cheap debt. So when they crush the economy, they're going to burst the asset bubbles, and therefore our wealth on paper is going to significantly take a hit even if you're really well diversified. And that's what's really sad about this particular situation where we are today, is it's not just, hey, once it was the tech bubble. If you were invested in tech stocks, you were in trouble. For me in '08, it was the financial crisis, and I was invested in financial stocks and I was crushed, right? Real estate was crushed. But there's usually been some diversification. And what's happened right now is everything is elevated. Everything is coming down to some extent. And unfortunately, it's a huge negative wealth effect, and it could be a significant negative wealth effect for quite some time unless you own hard physical assets that always have value and that will come back in value. And that's why I love real estate so much. For this time that we're in, even if values come down a little bit, they cash flow. And when people are forced with, where do I put my money? Am I going to put it in the stock market that's tanking when companies are in trouble as we go into deeper recession? Or am I going to put it in something that still produces me some income that I can hold through all of this, that one day will be worth more because these investors are pulling their money out of the stock market and putting it into real estate? So I'm thankful this time my money's in real estate and not in the stock market where it was in the last bubble.
Yeah, and we're going to try to close on a positive note. So I think you and I don't have a very good view of the next 18 to 24 months. It's going to be rough for most people. But what I see coming is actually a lot of opportunity.
Sure.
Right. There's a lot of opportunity ahead. And every bear market, every recession, there's so much wealth and so much opportunity. So let's try to close on a positive note and just tell people this is the time to do the work, double down, get committed, write great offers, right? Don't do good deals, only great deals. Because again, it could be a rough couple of years. And the last thing is if you're lucky enough to do 2 deals, Anna, I want you to make the second deal better than the first. You and I have no idea how this is going on. Look at it as dollar cost averaging and just get to work, because Olivia and I will be bigger, stronger coming out of this because we do the work every day. So let's close on a positive note.
Absolutely. And there's something called the cycle of emotions that goes with real estate cycles and goes with economic cycles. And, it shows that basically when you're at the top, it's like this irrational exuberance. Everything's great, right? And when you're at the bottom, there's fear and desperation. I mean, people jumping off skyscrapers, fear. And unfortunately, that is the time when we as investors can make the most money, right? I want you to be a good person, not take advantage of people, but you take advantage of the fact that this could be a once in a lifetime real low where you have the opportunity to buy assets really, really cheap compared to what we've seen over the last decade. And Buffett says, be greedy when other people are fearful and be fearful when other people are greedy. I don't take greed as I'm going to take advantage of someone, but I'm going to say, hey, we're in a situation that I didn't create and things are really tough, but I'm in a position where I can make it better for somebody, right? And I can make a wise decision to grow my wealth. And so create win-wins, look for those off-market deals, look for people that have to get out of the properties that they're in for whatever reason, and create a win-win situation. Get creative so that you can take their problem off their hands and you can create an opportunity for yourself at this time.
Yeah, that's so well said. Again, folks, there are amazing opportunities that will be in front of us, assuming you've done the work. Don't be scared. Understand, do the work, have a buy box. In these environments, the winners simplify.
Yes.
Right? Don't be a shotgun. Just focus. If you want to buy stocks, right? Get your list. Do the work. Great. You want to buy crypto? Do the work. Figure out the projects. If you want to buy sports cards or Beanie Babies or whatever, do the work. And Anna and I will be here to talk about real estate every week. Where can people find you?
Great. You can find me on my playlist on your channel. You can find me on social media at Anna Kelly, REI Mom. And my website is reimom.com.
Thank you so much.
Thank you.